Before we dive into the world of trading charts, it's important to remember that this video is for educational purposes only. It's not financial advice and should not be used as such. Our aim is to provide you with a basic understanding of trading charts and how they work. We'll be exploring the language of candlestick and Fibonacci charts, using them as tools to decode the market's movements. However, investing in the financial markets involves risk, and it's crucial to do your own research and consult with a professional financial advisor before making any investment decisions. Now that we've got that covered, let's begin our journey into the fascinating world of trading charts. Ever wondered how financial traders make their decisions? Well, they use a secret language, the language of charts. Just like linguists decipher ancient hieroglyphics, traders decipher charts. These aren't just fancy squiggles on a screen, but tools that help traders make informed financial decisions. They're the compass and map, guiding traders through the vast ocean of financial markets. Now, there are many types of charts, each with its own dialect. But today, we're going to focus on two of the most popular ones, candlestick and Fibonacci. Candlestick charts, they're like the Shakespeare of the trading world, classic, dramatic, and full of twists and turns. On the other hand, Fibonacci charts are more like Hemingway, straightforward, smooth, and easy to follow. Each has its own charm and utility, and understanding them is key to becoming fluent in the language of charts. By the end of this video, you'll be speaking the language of charts fluently, impressing all your friends at the next dinner party. Let's dive into our first chart type, the candlestick chart, the bread and butter of every trader. Now, where did this mouthful of a name come from? Well, the candlestick chart hails from the land of the rising sun, Japan, and was developed in the 17th century by a rice merchant named Munehisa Hama. He found that, instead of just looking at the price of rice, he could predict future prices by considering the emotions and psychology of the market participants. But what makes up a candlestick? Picture a candle. It's got a body, and it's got wicks. The body of the candlestick represents the opening and closing prices for a specific period. If the body is filled or colored in, it means the close was lower than the open. A bearish signal. If the body is empty or not colored in, it means the close was higher than the open. A bullish signal. Now, those wicks, or shadows as they're often called, are lines that extend from the body to represent the high and the low price ranges within the trading period. The upper shadow shows us the highest price for that period, and the lower shadow shows us the lowest price. Picture this: you are at a dinner party, and you see a tall candlestick with a short body and long shadows. You'd probably think, wow, that's a lot of volatility. And you'd be right. Long shadows on a candlestick chart indicate a lot of price movement or volatility within the trading period. On the other hand, a short candlestick with short shadows would be like a quiet dinner for two. Not much volatility, and the price didn't stray too far from where it started. So, there you have it. Each candlestick is like a story, telling us about the battle between buyers and sellers during a specific period. Congratulations! You've just learned the ABCs of candlestick charts. But hold your applause, there's more. Now that you've learned the basics, it's time to understand the patterns. Candlestick patterns are a trader's secret weapon. They're like the Morse code of the markets, providing signals that can help predict future price movements. So let's break down some of these patterns. First off, we have bullish and bearish candlesticks. Like the name suggests, bullish candlesticks indicate that buyers are in control, pushing prices up. On the other hand, bearish candlesticks signify a seller's market with prices trending downward. Now let's dive into some common patterns. Picture a doji candlestick. It's like a cross or plus sign, and it's all about indecision in the market. When you spot a doji, it means that buyers and sellers are wrestling for control, and a reversal might be on the horizon. Next up is the hammer, a bullish pattern that looks like, well, a hammer. It's formed when a security moves significantly lower after the open, but rallies to close near the opening price. This pattern suggests that the market is hammering out a bottom, hence the name. And then, we have the engulfing patterns. These are a pair of candlesticks where the body of the second candle completely covers or engulfs the body of the first one. A bullish engulfing pattern indicates a potential reversal to the upside, whereas a bearish engulfing pattern signals a possible downturn. Remember though, candlestick patterns aren't fortune tellers. They're tools to help you make educated guesses about market trends. So don't bet the farm on one pattern alone. Instead, use these patterns as part of a broader trading strategy, incorporating other technical analysis tools and fundamental research. Remember, in the world of trading, knowledge is power. The more you understand about these patterns, the better prepared you'll be to navigate the market's ups and downs. With these patterns under your belt, you're one step closer to becoming a trading whiz. Ready for round 2? Meet Heiken Ashi, the less famous cousin of candlestick charts. Originating from the land of the rising sun, just like our friend Candlestick, Heiken Ashi is a unique charting method that offers a different perspective on price action. Now, don't let the name intimidate you. Heiken Ashi simply translates to average bar in Japanese. It's a visual representation that uses the average price of 4 points, open, close, high, and low, to create a smoother chart. This differs from candlestick charts, where each bar represents the open, high, low, and close prices for a specific period. While candlestick charts are like a raw, unfiltered reality show, Heiken Ashi is the edited, polished version that highlights trends and patterns with greater ease. It's like comparing a gritty documentary to a well-produced drama series. Now that you have a basic understanding of Heiken Ashi charts, let's dig a little deeper. Heiken Ashi charts may seem complex, but they're actually pretty simple once you get the hang of it. These charts are a trader's best friend when it comes to identifying market trends. They're like the Sherlock Holmes of trading, always looking for clues and patterns that can lead to profitable trades. To interpret Heiken Ashi charts, you need to understand the language of the market, which is expressed through the colors and shapes of the bars. It's like learning Morse code, but instead of dots and dashes, we have green and red bars. A green bar indicates a bullish trend. It's like the market is saying, "Come on in, the water's fine." This is a signal that buyers are controlling the market, pushing prices up. It's the equivalent of a green light at a traffic signal, telling you it's safe to proceed with your buy orders. On the other hand, a red bar signals a bearish trend. It's the market's way of saying, "Hold your horses, partner." This indicates that sellers have taken the reins, driving prices down. Consider it a red light, advising you to stop and reconsider before placing buy orders. But here's the twist. Unlike traditional candlestick charts, Heiken Ashi charts smooth out market noise and highlight the trend direction. This is achieved by calculating averages, which makes the chart look like a flowing river rather than a choppy sea. So if the chart looks like a field of green, it's a bullish trend, but if it's a sea of red, it's a bearish trend. However, remember to look for a series of consecutive bars of the same color to confirm a trend. A single green or red bar is like a lone wolf. It doesn't necessarily indicate a trend. Remember, trends are your friends until they bend. So always validate your trend analysis with other technical indicators to avoid getting caught in a market trap. And just like that, you've mastered another chart type. But remember, with great power comes great responsibility. Well, you've made it to the end. You're now officially a chart expert. If there was a chart Olympics, you'd be on the podium. But let's not get ahead of ourselves. Let's recap what we've learned. We started our journey with candlestick charts. Remember, they're the ones that look like little candles with wicks at both ends. We learned that these charts give us valuable information about the opening, closing, high and low prices during a specific period. We also learned how to interpret the patterns that these candlesticks form. These patterns can help us predict future market movements. Next, we dove into the world of Heiken Ashi charts. And no, they're not a type of sushi. These charts use a unique calculation method to give us a smoother look at price trends. They help us filter out the noise, making it easier to spot trends and potential reversals in the market. But let's be clear, understanding these charts doesn't mean you've got the Midas touch, turning every trade into gold. It's a tool in your trading toolbox, not a crystal ball. The success in trading comes from practice, continuous learning, and a good deal of patience. Remember how we talked about bullish and bearish patterns? How they're not just Wall Street jargon but give us clues about the market sentiment? Well, it's time to take that knowledge, roll up your sleeves, and start practicing. Apply what you've learned to real market scenarios. Start with virtual trading if you're not ready to risk real money. Continuous learning is also key. The world of trading is dynamic, it's not going to wait for you. So keep updating your knowledge, read books, take courses, join trading communities. Surround yourself with people who are better than you. That's how you grow. And most importantly, be patient. Rome wasn't built in a day, and neither will your trading empire be. It's a journey, not a sprint. So take your time, learn from your mistakes, and enjoy the process. Remember, the journey of 1,000 miles begins with a single step, or in this case, a single chart. Happy trading.